All right, so let's talk about dividend yield a little bit. I was saying before, if you're investing with a company by buying shares of their stock, what you want to know is what is your return on your investment, especially for people who are looking to, have a good passive income stream. Right, that's the whole thing, right? Retire when you're 40 and have a good setup passive income stream. Well, this is one of the ways that people do it. Is they buy stock that have a guaranteed dividend or reasonably guaranteed dividend. All right, so if I'm going to invest with a company, if I'm going to buy their share of stock, what is that return look like for me? Okay, so here we go. Considering only dividend payments, which of the following of these companies looks to be a better investment? Well, the calculation is for dividend yield. Dividend yield is actually pretty easy. It's dividends per share, right? How much is each shareholder getting of dividends divided by market price per share. How much is that stock going to cost me? And what is the return on the investment? So it's just a simple division, 80 cents divided by $16 for company A. I'm getting a 5% return on my investment. Not bad. Well, let's look at company B. It's a more expensive share of stock, $90. You would think that'd be better, right? Because you're buying a more valuable stock. And you're getting $3 dividends of 80 cents. Awesome, right? But if we divide them, the dividend yield is only 3.3%. You'd be better off buying several shares of company A stock and you have a better return on your value. So don't just look at the fact that it's 80 cents or 20 cents. You need to be looking at what are you putting out, like how much are you buying that stock for and how much of a return are you getting on it for the dividend yield. Now that's not the only reason you're buying a share of stock, right? There's two reasons you're going to buy a share of stock. Number one is you're hoping for dividends. And companies, if they know that they are known for traditionally paying out dividends, and that is why people are buying their stock, they will do their best to continue to pay out dividends. Okay, so dividends are one reason you buy a share of stock. And the second reason is one that you all know. You're hoping that the price goes up and they can sell it for some sort of gain in the market. So it says, so for the part 2 here, assume a company has a dividend yield on its common stock of 2%. Is it a poor choice? Not really, because maybe you're not buying it for the dividend. Maybe you're buying it because you think the stock price is going to jump up and you're going to have a huge gain on the sale. Okay, so those are your two reasons, dividends or the capital gain when you sell the stock. Those are the two reasons you're buying stock. But again, those who are looking for that passive income stream are looking for stock that pays out dividends regularly. All right, stock splits. This is kind of I think this is one of the funny things in my opinion. Have you ever watched a movie, like a boiler room kind of movie, where everybody's like, oh my gosh, company X has split, the shares are splitting, we're millionaires. No, you're not. Not initially, anyway. Maybe if the price on the stock goes back up, then you'll be millionaires. But initially, it really doesn't do anything to your overall value when there's a stock split. Now, let's illustrate that. All right, if there's a stock split, the number of shares that are out there increase, the par value of each share decreases, the market value of each share should also decrease. All right, let me illustrate this. Bravara Corporation has 10,000 shares of $20 par value stock, common stock, selling at $100 a share. Okay, so you get 10,000 shares of stock, $20. That's $200,000 you've got listed in your common stock. And the sales price right now, the market is trading the stock at $100 a share. What if there is a 2-for-1 stock split? Well, now instead of one share of stock worth $20, guess what? You now have 2 shares of stock worth $10 each. That's it. All right. So instead of one $20 share, you now have 2 $10 shares. You still have $20 in common stock. The overall value hasn't changed at all. So let me show you. The new par value will be $10, right? Because it's 2-for-1. And the new number of shares that are out there, instead of 10,000 shares, there's now 20,000 shares of stock out there. The theoretical new market price, the idea is if you flood the market with double the amount of shares of stock that are out there, in theory, the market price will drop because, right, economics. You put more out there, the price is going to come down. So in theory, the stock should start trading around $50 instead of the $100 it's at now. And that's one of the main reasons you would do a stock split, is you want to bring the market price down. Maybe the stock is trading at such a high amount that like regular people can't invest in it. So you can issue a stock split and bring it down so that more people can invest in your shares of stock. So that is one of the primary reasons for a stock split. All right, so I want you to look at the overall value. Remember, before the stock split, we had $200,000 in common stock. Well, guess what? Afterwards, we have $200,000 in common stock. That doesn't change. Just the makeup of the common stock has changed. Okay, because now we have $10 per share, par value times 20,000 shares. Still $200,000 in common stock. Okay, 4-for-1 stock split. Same concept, right? So instead of $20 par value, now they're going to be $5. And now instead of, if it's 4-for-1, now instead of 10,000 shares, it's 40,000 shares. And in theory, it'd be $25 as the new market price. I mean, that's in theory. The idea though, guess what? You still have $200,000 in common stock. It's just built differently, right? It's comprised of different amounts. All right, last one, 10-for-1. Rather extreme. I don't know. I can't imagine 10-for-1 it's got to be pretty rare. All right, but if that's the case, each share of stock would be worth $2, right? $20 to 2 divided by 10, and you'd have 100,000 shares out there. Guess what? You still have $200,000 in common stock. Okay, so the overall stock value doesn't change. That's why I'm saying the Boiler Room movies, everybody's like, oh my gosh, we're rich. No, they're not. not initially. If the market price went up, great, then maybe you'd be rich. But, initially, no. Okay, that's our end of our conversation there. The last thing we're going to do, and I think, oh no, this isn't the last. No, I'm not going to. I'm going to show you a quick example, accounting for a stock split. I want you to see that this is a stockholders' equity section, and this is the paid-in capital part of it, right? So the stock section, and then retained earnings. If there was a 2-for-1 stock split, what would happen to the stockholders' equity section? Well, you know what? The only thing that's going to happen, same thing that happened before. Instead of a $1 par value, 2-for-1 stock split, it is now going to be a 50-cent par value. And instead of, the authorized stock is still 490 million. That doesn't change. There's still 490 million shares of stock out authorized. That's what's written in the charter, if you remember. That didn't double. What's out in the world doubled, the outstanding stock. So we've got 119 million, I think that is, shares of stock issued and outstanding. The ones that are out there in the world are the ones that are going to be getting that second share of stock, that split. So instead of, it can't be 119, 490 million shares of stock and 238. So the only thing that happened is the same things that happened on the previous slide. You split the par value, you double the shares of stock that are out there because it's a 2-for-1 split. The overall value, 119 million, doesn't change. Okay, paid-in capital and excess par, does that change? No, nobody's giving us any more money. That's still the same. Total paid-in capital, still the same. Retained earnings, we aren't even talking about retained earnings. That doesn't get touched. Still 654 million. Total stockholders' equity, 921. Same numbers. The only thing that changes is what it's made up of. All right. Okay. All right. So why would we buy treasury stock? Well, we want to increase the stock price. Let's say your stock is trading at a really low price out in the market, and you're like, we have to bring that price up. So if that's the case, right? Economics, supply and demand. If we take some back and we purchase treasury stock, in theory, the market price will rise because there's less of them out there. So it's one of the main reasons you're going to buy treasury stock. I mean, if you have extra cash in your business right now, you might buy some long-term assets, you might pay dividends. Another thing you might do is you might buy treasury stock to try to bring your market price back up. I mean, you can do a lot of things with your treasury stock. You can turn around, you can repurchase your own stock in the market, and you can turn around and you can give it to your employees as a bonus, right? I mean, you can do a lot of things with your own stock when you repurchase it. There you go, stock compensation for employees. I thought I was there. All right. The only treasury stock entry we're doing is the most basic of them. All right, there's many of them in your chapter, but we're going to hit only the most basic one. Lori Corporation purchased 10,000 shares of its $5 par value common stock for $50 per share. Guess what? I only care about what I paid for them. I don't care about par value. So I'm going to record treasury stock. I'm going to record that for what I paid for it, and a credit to cash for the $500,000 I paid for it. The way the stockholders' equity section is going to look after something like this, hang on, we don't care about the par value, there we go, is if you think about it, you've got paid-in capital, you've got retained earnings, you would subtract treasury stock because the paid-in capital amount, the common stock amount, is going to have all the stock that you sold. all the amount that was issued and outstanding. And what you'll do is you'll subtract the amount you repurchased in the market as treasury stock there, and that'll be your total stockholders' equity. All right. And we're almost done, so let's just finish this up real quick. Retained earnings. I hope you certainly know what retained earnings are at this point. I'm really kind of rehashing Chapter 4 in the Statement of Stockholders' Equity, or the Statement of Retained Earnings, whatever you want to call it. Retained earnings. Earnings from operations not distributed to shareholders. Okay, so here's our typical retained earnings statement. If you remember, the way it starts is you start off with how much have we saved in the past, retained earnings, plus what did we make this year, minus any dividends, gives me ending retained earnings. So in this case, retained earnings, Kingston had beginning retained earnings of $135,000. Fine, beginning of the year. Plus, this year, we made $75,000 in net income. Good for us. And then we turn around and paid $85,000 out in dividends. Okay, that was our choice. So at the end of the year, we had $125,000 in retained earnings because we paid out more than we made. And that's it. Okay, but it was important to hit that because that is the final part of stockholders equity, shareholders equity on the balance sheet. I hope you had a great time listening. Have a nice day.